Imagine DeFi as a wild playground where everyone is running around, trading, lending, borrowing, but every slide, swing, and sandbox is built by a different team. Fun? Sure. Safe for serious money? Not even close. Now picture that same playground suddenly remodeled to feel like Wall Street, except the entire thing runs on transparent blockchain rails instead of hidden spreadsheets. That is what people mean when they say institutional-grade DeFi. It's not hype. It's about segregated custody, meaning your assets aren't mixed with anyone else's, like having your own locker instead of tossing your stuff in a shared bin. It's clean settlement, where trades finalize without random delays. It's low-slippage execution, so a $1 million trade doesn't move the market like a speedboat flipping over a kayak. And it's high throughput, meaning the network can handle real traffic instead of lagging like a 2010 laptop. Here's where it gets interesting. These features used to exist separately. Custody was one place, liquidity another, fast execution buried somewhere else. Retail could navigate the chaos, but institutions couldn't. But now, everything just snapped together. Bybit brings the custody and clearing rails. Mantle provides fast, low-cost L2 block space, and Aave V3 delivers deep lending and borrowing liquidity. The three systems now link like HDMI to power cable to screen. Suddenly, the picture loads instantly. The important part, this removes the operational friction that kept big capital out. And when big capital flows in, the entire DeFi landscape, yields, liquidity, and market behavior changes overnight. Once institutions can move money through DeFi without friction, the entire feel of liquidity shifts. It stops acting like a small-town marketplace where every big trade makes the whole crowd turn around and starts behaving like a global stock exchange where volume is deep enough to absorb real size. This is where concepts like spread compression, deeper order books, and more stable AMMs come in. Let's break that down using real-world scenarios. Spread compression simply means the difference between the buy price and sell price shrinks, like gas prices at 3 stations on the same street slowly aligning. Deeper order books mean there's more money waiting at each price level, so a 500K trade doesn't move the market like a bulldozer on a gravel road. And AMM stopping their wobble means they no longer swing wildly when big players push size. They behave more like shock absorbers than trampolines. And here's the key transition. When the flow changes, the market structure changes. The type of money entering a system affects how that system behaves. Institutions don't YOLO into market buys like retail traders. They use slow, deliberate execution algorithms, the kind that slice orders into hundreds of tiny pieces, minimizing detection and price impact. Think of it like pouring water slowly into a cup instead of dumping the entire bucket at once. When that algorithmic flow enters AMMs, the rules change. MEV tactics shift. Slippage drops. Price impact shrinks. Yes, some short-term alpha dies, but in return, the ecosystem unlocks far deeper, more reliable liquidity that wasn't accessible before.
Everyone wants to understand what happens to yields when institutional money finally enters DeFi. So let's start with the simple truth. When big players arrive, returns spike fast. Think of it like a sudden surge of riders entering an Uber zone. Prices surge because demand jumps, and every protocol that relies on liquidity sees utilization rise. But here's the part most people forget. That initial yield boost is temporary. It's a short-term sugar rush, not a permanent condition. Once institutional capital becomes comfortable, their money stops bouncing around. It settles. And as it settles, yields compress into something way less exciting, but far more predictable. Imagine going from a wild summer fling to a stable, long-term relationship. Date nights become consistent. No surprises, no fireworks. That's what institutional liquidity does to APYs. Steady, dependable, and nowhere near the 300% degen days. Now let's talk about volatility. With institutions in the mix, price swings drop because large, disciplined capital absorbs noise. It's the difference between a speedboat and a cargo ship. The bigger the vessel, the less it shakes. But here's the catch. When stress hits the market, every institutional desk reacts the same way. They de-risk together. They reduce exposure at the exact same moment. And when trillions move in sync, the calm surface suddenly snaps into violent motion. We've seen this play out in traditional markets during events like March 2020 and the 2022 rate hikes. Smooth until suddenly not. That's the real institutional effect. Higher stability until the storm arrives.
Think back to what happened when the 2024 Bitcoin spot ETFs were approved. Bitcoin didn't just rise, it went wild. First came volatility as every fund scrambled for exposure. Then came legitimacy as institutions treated Bitcoin like a real asset class. And finally, the floodgates opened. Trillions in traditional capital began allocating systematically. That sequence matters because while history never repeats perfectly, crypto loves a remix. And today's remix is happening inside DeFi, not around it. The Bybit Mantle Aave dynamic is the clearest signal yet. Instead of institutions buying Bitcoin through Wall Street wrappers, they're now moving directly into the protocols themselves. This is the equivalent of skipping the ETF and stepping straight onto the trading floor. Let's break it down with something simple. Imagine a city where investors used to stay in hotels outside the walls. They visited, spent money, and left. but now they're buying apartments inside the city, becoming part of the infrastructure. That's what institutional liquidity flowing directly into DeFi primitives looks like: permanence, not tourism. And this shift matters because protocols aren't assets you trade once and forget. They're economic engines with real-time cash flows, governance power, and liquidity incentives. So when real money comes in, it changes the engines from within. The opportunity is massive: deeper liquidity, tighter spreads, and a market structure that starts resembling traditional finance, but without the intermediaries. The remix is here. This time, the institutions aren't buying Bitcoin ETFs, they're buying DeFi's future. Here's where the story takes a slightly uncomfortable turn. Institutions don't step into any market unless their non-negotiables are met. They want segregated custody, which is basically having their assets locked in their own safe, not tossed into a communal locker. They want insurance because billion-dollar desks can't afford oops. They want auditable accounting, meaning every transaction must leave a clean paper trail. And above all, they want legal clarity, so no regulator blindsides them with a surprise lawsuit. And here's the transition most people underestimate. The moment you build systems that satisfy institutional demands, regulators start paying attention. It's a package deal. When institutional rails enter DeFi, safety undeniably improves. Fewer rug pulls, better risk controls, and infrastructure that feels less like a casino and more like a financial grid. Live data already shows this trend. Protocols with verified audits and institutional-grade custody partners are pulling in more stable liquidity than degen farms offering 200% APY. But the trade-off is unavoidable. Oversight ramps up, compliance thickens, reporting becomes normal, and suddenly the wild experimental corner of crypto shrinks. Many YOLO tokens, the ones with no roadmap, no revenue, and no real utility, simply won't survive in a world where regulators and institutions share the same playground. That's the glow-up. DeFi becomes stronger, safer, and more legitimate, but it loses a bit of its chaos magic. And that's the price of maturity.
So who actually wins in a world where institutional-grade DeFi becomes the norm? It's the protocols that solve real operational problems, not the ones shouting the loudest on Twitter. The winners are the systems offering safety, high throughput, and compliance-ready architecture. Think Layer 2 networks like Mantle that deliver fast execution without turning into technical choke points. Think custody partners that offer segregated vaults instead of shared pools. Think settlement layers that guarantee finality, meaning once a transaction clears, it truly clears. These platforms line up perfectly with what institutional capital requires: predictable performance, audited processes, and the ability to move size without breaking the market. And the losers? Anything built on fumes rather than fundamentals. Meme coins with no utility, protocols allergic to transparency, and anonymous teams with no track record all get filtered out instantly. Institutions don't gamble on vibes. They chase risk-adjusted returns, which is a fancy way of saying, how much do we earn for every unit of risk we take, and can we prove it on paper? Meme tokens and degen farms rarely survive that math. Live market inflows are already showing this shift. Liquidity is consolidating around products with audits, governance history, and real revenue. Now here's the segue into the part that actually matters. Given this massive structural pivot, what should you be doing with all this information? Because understanding institutional DeFi isn't the end, it's the setup. What comes next determines who gets ahead and who gets left behind. So let's talk about what all of this actually means for the people inside the system: the builders, the traders, the liquidity providers, and the teams managing risk. Because once institutional-grade capital enters DeFi, the rules of the game shift and everyone has to adapt. For builders, the message is simple: start building like corporations will be your users. That means audited smart contracts rather than experimental code. It means adding custody hooks so assets can sit inside regulated vaults instead of floating in generic pools. And it means providing clean accounting formats, the kind CFOs can plug directly into quarterly reports. If your product can't be explained in a boardroom, it's not ready for institutional flow. For traders, the landscape changes too. Expect compressed spreads, meaning the difference between buying and selling prices gets tighter. Why? Because institutions use algorithmic execution, similar to how major Wall Street firms operate. They don't make chaotic market buys, they drip liquidity with surgical precision. This creates smoother markets, but reduces easy arbitrage. For LPs, prepare for yield normalization. Early yield spikes will look exciting, but once large players settle in, returns tend to flatten. It's like a new restaurant opening. Crowds rush in at first, but things stabilize once regular operations begin. And for risk teams, here's the big one: plan for synchronized deleveraging. When institutions de-risk, they often do it at the same time.
That's the nightmare scenario, coordinated exits that can amplify volatility across the entire ecosystem. The future is bigger, cleaner, and more structured, but far less forgiving for anyone unprepared. If this video resonates with you, click on the card above to watch more insightful videos. This is Blockchain Money,